Hello and good morning, everybody. My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing to my channel so you see more. Been a busy couple of days, lots of companies reporting earnings. Uh, I've gotten through almost all of them that I would like to. But up next is Republic Services, ticker RSG. This is one that I've covered extensively on the channel and plan to continue doing so. But they reported earnings yesterday, and in this video, I would like to review the earnings report on camera for the first time. I have not looked at their earnings. The stock is modestly up today. I believe that we are underperforming the market today. Let's take a look. Oh no, okay, so we are. The S&P 500 is slightly red, whereas RSG is green. So it does appear that the market is reacting positively to the earnings, and let's find out why. Recently, I made a video and wrote an article here on Seeking Alpha where I reiterated, a positive stance on the name. And basically, the idea was, kind of breaking down that there's an additional layer to the thesis that I find even more compelling than before, which is that it is, kind of one of my top ideas to create relative outperformance versus tariff risks. And, this is all despite a very, very objectively expensive valuation. Now, we do see in the 9 days since this article was published, we have underperformed the index by almost 5 points, 4.5 points. I think the reason for that is in the last few days, particularly, there's been some signs of de-escalation in the trade war. However, I'm skeptical that I'm highly skeptical that the trade war will amicably resolve anytime soon. I've positioned my portfolio as such, including a slight addition to my position in Republic Services within the last few weeks. But, we do see names like what we covered yesterday, Lam Research, tickers like that are inversely correlated to negative tariff news. Those have done really well the last few days, whereas more defensive plays like Republic Services, not as much. So without further ado, let's get into the earnings. I'm just going to navigate directly to their website first. Go to their investor relation piece right here. Let's take a look. That is a 5 cent per share beat. I believe that is at least the fourth quarter in a row that we have seen an earnings beat. But we did have a slight revenue miss, 37 million. So first quarter earnings per share of $1.58. Let's just calculate our valuation based on that. $1.58 times 4 quarters is $6.32 a share. The price is $241.84 divided by 6.32. So our forward earnings multiple is 38.25 times. Very, very expensive based on those numbers. Now, the forward earnings are expected to increase, and it does. I'm admittedly not sure if our Q1 numbers are typically softer than the Q4 numbers of the prior year, but that is what we're seeing here. So we actually do see that they did miss that 30-something million dollar miss. Basically was the difference between revenue being flat. So revenue did slightly decline And gross profit slightly declined as well. In fact, gross profit is the lowest gross profit that they have shown since June, the quarter ending June. But anyways, let's go back to this. Expanded first quarter net income margin 50 basis points, adjusted EBITDA margin 140 basis points. That's pretty good, very modest. Nothing mind blowing about that, but good. Generated cash flow from operations one 1.025 billion and adjusted free cash flow of 727 million. Let's just calculate our free cash flow yield. 727 million versus their current market cap of 75. So that is a free cash flow yield of 3.865%. So free cash flow yield continues to be below the 10-year treasury, indicating that there is a very high level of perceived safety with this stock. This is something that we've discussed before, that it's really, really hard to get excited about this company. It's a boring cash generative business with an objectively expensive valuation that just continues to demonstrate multiple expansion over the last few years. One thing that they did discuss here, they invested more than 800 million in value creating acquisitions. So first reaction there, they are investing out of cash reserves and basically investing their between dividends, buybacks, and the dividends and buybacks versus the adjusted free cash flow versus the value creating acquisitions. We still see a strong emphasis on growth here. This is not a business that is, just raising their prices incessantly and returning all of the free cash flow back to investors. However, it would be helpful maybe while I'm thinking about it if we reconciled how the acquisition numbers get reconciled back into the cash flow statement, and if the adjusted cash flow, free cash flow, is prior to or X the acquisitions, though I would assume that this happens after the fact. So I would expect their cash balance to decrease slightly. So John Vander Ark, the CEO and president, says, "We're off to a solid start to the year and our business continues to perform well, even with increased volatility in the broader economy. While top-line results were impacted by sluggish cyclical volumes and challenging winter weather, we generated high single-digit growth in EBITDA and 140 basis points of adjusted EBITDA margin expansion by pricing ahead of cost inflation and effective cost management. Our ability to produce these results reflects the resiliency of our business model and the financial benefits we are delivering by investing in our differentiating capabilities." Okay, so moving into the highlights, total revenue growth of 3.8% includes 2.9% organic growth and 0.9% growth from acquisitions. That's a meaningful amount, actually, at least in the context of this kind of low, mid single digit top line growth. The impact of one less workday decreased revenue by 50 basis points compared to the same period. So last year was a leap year, I believe, and that's what they're talking about. Core price on total revenue increased revenue by 6.1%. Core price on related business revenue increased revenue by 7.3%, which consisted of 9% in the open market and 4.6% in the restricted portion of the business. I have a question which I cannot immediately answer off the top of my head. The question is, why did our revenue grow less than this? Is something else in the portfolio dragging? That's something to investigate further. Revenue growth from average yield on total revenue was 4.5%, and volume decreased revenue by 1.2%. Sluggish cyclical volumes. One thing that I covered 2 days ago was the Carlisle Company's earnings report. They printed some pretty their guidance they reaffirmed. The market felt very good about it. The stock got bid up on earnings. However, I noticed in their numbers and didn't want to read too into it, but there were some clues in their numbers that construction. There's a slowdown in construction, and potentially, and we saw that in the Prologis earnings, that they were kind of pulling back on some of their planned spend. And then we also saw that in the Carlisle numbers as well. We know that the industrial and commercial waste businesses that Republic Service is doing are a little bit more exposed to cyclicality versus just the residential collection business. So I think we see here that volume had a negative impact on revenue by 1.2%, which is fairly meaningful. That's the difference between 5 and 3.8, right? Mid single digits to mid low single digits. So it's conceivable to think that volume might have decreased more than that if they had strong pricing on the revenue. So kind of a mixed bag of results there. Revenue growth from average yield on related business revenue was 5.4%, and volume decreased related business revenue by 1.5%. So what I'm seeing there is that, yes, volumes have softened somewhat, which is what we see in a recessionary environment with these garbage stocks. Their volumes do decrease. However, the thesis is not that the volumes remain constant during that time. It's that pricing power remains strong, particularly in an inflationary environment where they have lots of pricing that's CPI linked. So their net income margin, 12.3%, representing roughly $500 million. Earnings per share being $1.58, an increase of 9.7% over the prior year. So that's very strong. That's very strong growth. Some would argue that for a stock that's 35 times earnings, 38 times earnings, in the 30s multiple, that a single digit, even if it's edging up to double digits, high single digit revenue is, profit growth is not very good. And they certainly wouldn't be wrong to say that. However, I think we need to temper our opinions about that with what the market tells us. And that is, you have stocks like Costco, which repeatedly will, register and print, year-over-year sales results that are in the, mid-high single digits, and they have very low operating leverage too, which the Costco I'm speaking to. So their profits will increase, between 8 and 10% each quarter over the sequential quarter over the prior year, and it seems like the stock is prohibitively expensive. But the fact that the company continues to outperform and the multiple is so high is more of a indicator of the perceived safety and stability of those cash flows rather than pricing in this insane growth. Hopefully what I'm just saying made sense. It is encouraging to see that our earnings per share is meaningfully up versus revenue growth over the prior year. Adjusted earnings per share, a non-GAAP measure, also $1.58 per share, increase of 9%. Adjusted EBITDA, $1.25 billion, and adjusted EBITDA margin, again, non-GAAP, was 31.6%, an increase of 140 basis points. So margin expansion again. So very, very strong operating efficiency that we're seeing. Here they're actually being a little bit more specific, that they invested $826 million versus the $226 million cash return to shareholders, $45 million in buybacks, and $181 million of dividends paid. So what's interesting about that is that you see that there are many companies in the market, many companies that return substantially more of their cash to shareholders in the form of buybacks than they do dividends. One notable example that I can think of off the top of my head is Visa and MasterCard. They return all free cash flow pretty much to shareholders, of which 80 to 90% of that is buybacks and the rest is dividends. So they have small dividend yields and low payout ratios on the dividend side, but their payout ratio is pretty close to 100%, and that accretes a lot to earnings per share. What we see here with this company, and again, Costco, Costco is a completely different business, but it has similar qualities to this business. I see a lot of analogs there, where there's there's much less share repurchases, and the majority of cash return to shareholders is in the form of dividends. The reason that I actually like companies like that, or admire companies like that, is that their earnings per share growth is more of a true number of their profit increase. Here, net income being 495 million versus the quarter a year ago, 453. They don't report the year-over-year increase in net income, but I'm going to. 495 divided by 453.7. So that represents a 9.1% increase. So the buybacks increased the earnings per share on a GAAP basis by 60 basis points, and basically in the non-GAAP measure, 9%. It also might be possible that in their reconciliation that their adjusted earnings per share, they actually net out the impact of share repurchases, although I would find that unlikely if they were to do that, mainly because they have an incentive to do the opposite of that. Company's average recycled commodity price per ton sold at recycling centers was $155. This represents an increase of $2 per ton over the prior year. So commodity prices are very modestly increasing. I mean, that's like a 1.5% increase. Company completed and commenced operations on one renewable natural gas project during the quarter. They declared a dividend, same as the prior quarter. They continue to have very low amounts of cash relative to their long-term debt, which is fine. But just something to note, their current liabilities, 3.5 billion, current assets, 2.3 billion, of which the majority of that is accounts receivable. So I think the thing that I like the least about the business is the limited amount of cash they keep on hand. There's good and bad sides from that, right? The good, of course, meaning that they're very efficient in their use of resources, and no dollar is left unspent for the sake of growth and continued compounding. However, if for whatever reason they were to face immediate and sudden financial hardship, then they would likely need to finance it with debt. But nothing concerning about that if you're not a total doomer. So we see revenue. I believe our revenue was 2.8%. Is that over the prior year? Let's just reconcile that. Let's calculate that. 4009 divided by 3862. Yeah, so that's the number they're doing year over year, 3.8%. One thing that I'm not sure they do here, I don't believe that they do decks for their earnings. However, this investor presentation here was released after the last video we made and after the last article I wrote. So I'd like to at least take a look at this and see if there's anything different. Most of these decks are pretty much the same as the one prior. Yeah, see, this is just for the full year is what this is. 3-year compound annual growth rate, earnings per share 16%, free cash flow 13%, return on invested capital going up now in the double digits. Definitely what you want to see, but the fact that we're seeing increased ROIC is very good. Okay, so here they gave their guidance. So what they're saying is their guidance is for volumes to be flat, or at least to have a flat impact on revenue, meaning that they do plan to either plan or expect their mechanisms of pricing power to carry the load here in this given year. Now, um, they say revenue 16.85 to 16.95. So they, are expecting sequential growth in revenue from here on out of the remaining 3 quarters to be, 850 to 950 billion roughly. So do the math. That's roughly 300 billion or 300 million rather each quarter to grow to hit this guidance. We have earnings per share in this range. So their current quarter annualized is 632. So we're more than 50 cents from hitting our guidance. A couple things to note here. Well, I don't doubt that they'll hit this guidance because they, quarter after quarter, they've shown very consistent growth over time. One thing to note is that they reported the volume impacts that they reported in this quarter were more severe than what they're reporting for the total year here. So while it remains to be seen if we don't have the volume numbers here necessarily, and they don't, at least in these financials here, they might in the financial supplements, they don't report volumes. So that we don't have good insight into volumes. We only have good insight into the impact of volumes. Another thing that they said was they guided to $1 billion of acquisitions. They spent 800 million on acquisitions in the first quarter. So they're basically almost tapped out on that guidance. So reasonable to expect that there's limited amount of money spent on acquisitions through the remainder of the year. So when I measure up this guidance versus what I see in this quarter, I think what I'm looking at here is a very, very underwhelming quarter. There's nothing that changes my outlook for the company, but it definitely, there's nothing about the quarter that makes me excited. You had, slightly lower revenue. In fact, this is the lowest revenue we've seen since that March quarter. That was not the case in the prior year. If you see March, again, just to illustrate what I'm talking about, we go from 3.86 billion to 4.05, 4.07, 4.05 down to 4. So while we did have, a 3-4% increase year over year, we had almost a 10% increase in revenue in the March 2024 quarter over the March 2023 quarter, right? So I don't think that's something we should read into too much, but it is something to pay attention to, that we certainly do not have the same level of momentum entering the current quarter that we did last year over the prior year. You see here, from December 2022, we had 1, 2, 3, 4, 5, 6, 7 straight quarters of quarter over quarter revenue growth. But the last 2 quarters, revenue has decreased. Okay. This table does not allow me to scan back to see what happened before if we saw similar numbers in prior years and kind of do a more comprehensive analysis there. But what I see here is, although the year over year numbers are still on a strong enough time frame, we are seeing some deceleration here, and that's certainly what we're seeing here. While it's not confirmation of a new trend, it certainly is a break from the trend that we saw over this time frame, right? So that's something to monitor. Um, and then if we look at operating income, um, of course, that's been, here we did have a decrease slightly, return back, and have gone up. But if we look at operating income year over year, right, that number's still strong. But we now have one, two, again, same in operating income as we saw in revenue, 2 straight quarters of operating income decreasing, albeit slightly. However, gross profit in December 2024 did not follow that trend. However, we did see pretty, I don't want to say a sharp drop off, but less gross profit in this quarter by $200 million versus December. If we look at the net income, or earnings from continuing operations, but what they describe as net income, we see here 495 million. Again, we calculated that it was 9% more than the prior year. However, again, we see 1, 2, 3, so 2 straight quarters of net income decreasing. One thing to note here is that in the prior quarters leading up to March, so 2023 to 2024, we saw something similar, albeit still different. We decreased to the December quarter and then bounced back in the March quarter. And this March quarter here over this March quarter here, $70 million of increase. That's like a mid-teens level of increase, almost 20%, versus here we have 9%. So again, what we're seeing here is when we zoom in really close to the quarterlies, we're seeing a slight deceleration here in financial results. What we're seeing on the share level is a little bit more advantageous because, again, shares continue to decrease, right? So that's always going to smooth out our earnings per share numbers. If we buy back shares, they smooth out earnings per share, which is good. They still have a fairly low payout ratio, less than 40% for the given quarter. But let's take a look at EBITDA. EBITDA did not follow the same patterns that we saw in the other numbers, where we had 2 straight declines in EBITDA. We actually saw a bump in EBITDA quarter over quarter. Let's take a look at their balance sheet. Again, one thing that I just mentioned is very little cash, plenty of AR, which is good. So 2.3 billion of current assets, prepaid expenses, you can probably net that out. So really, we don't have their any sort of revolving credit here to get an idea of their liquidity, but roughly 2 billion of current assets that are legitimate. I don't fully understand how prepaid expenses factor into all that, but worth noting. Again, the balance sheet continues to carry quite a bit of goodwill. In fact, I see that the goodwill is increasing every single quarter, and then intangible assets increasing as well. So I'm a little curious to learn more about what we're doing there. Short-term borrowings, we see here that they did dip into conceivably some sort of revolving credit facility, but there was no current portion of long-term debt that came due. So they did bridge finance with a revolver here. I think understanding and knowing that we had 220 million returned to shareholders versus 800, almost 800 million in free cash flow, and we made an acquisition or had several acquisitions maybe for 800 something odd million, that the part of the acquisition was financed with short-term debt, which they could easily pay off quickly over time. Retained earnings again continuing to go up, indicating that they're reinvesting quite a bit back into the business. We know that they're doing that because of the fact that they basically spent more on acquisitions in the given quarter than they had cash flow to do so. So, yeah, we see here cash per share 27 cents, very, very little cash per share relative to our share price there. So, look, here's the deal. Taking a look at these earnings, maybe we should take a look at some of the highlights here. They reaffirmed full year guidance, plans to deploy billion in acquisitions. They did note that cyclical volume challenges remain, particularly in construction and manufacturing. So there's another data point that we've seen in these earnings reports, that there's signs that there is a slowdown occurring in construction. Now we're seeing manufacturing. So that gives you an idea about the short-term volatility created by the trade war. If the tariffs are really intended to reshore manufacturing as a primary objective, they certainly have not done so to this point, because what we're seeing is businesses pull back some of their investments or slow down some of their investments in domestic manufacturing. And I think that gives you an idea of the business reaction, the business community reaction to the rollout of the tariff policy. So again, that's something that we need to continue to monitor. That's a potential recession indicator. Although it's been a very tough couple years in just real estate in general due to debt costs and the like. Due to debt costs and the like, you're seeing comments. You're seeing lots of clues here, recessionary indicators, potentially, but not something that we should panic about or read into too much. It's something that we should continue to monitor. So, adjusted EBITDA margin expanded to 31.6, 140 basis point increase. This is stuff that we already looked at. Let's just listen to the transcript and let's listen to what they have to say about tariffs. So, Sabahat Khan, hopefully I'm pronouncing that right, with RBC Capital Markets, has the following commentary. Maybe if we could just start by commenting on maybe what you're seeing out there, maybe more cyclical parts of the overall business, any changing trends through the quarter, and anything that might have evolved into Q2. Sure, yes, look, Mr. Vander Ark, the CEO, says, sure, yes, look, we mentioned cyclical volumes have been down. That's really been true for the last 3 years. We've been in a negative demand environment, really led by construction and manufacturing. It's a little difficult to tell when you mix in the weather what's happening. Certainly January and February were softer, and March has picked up, and April saw in that trend. I think we have a flaw in our transcript there, potentially. But nonetheless, so we feel good about that. It does appear what he was communicating is March and April ticked up slightly. So that actually is a good sign, I would say. But I think on the construction side, we're expecting more flatness throughout the rest of the year, just given where the 10-year interest rate is. And we've got to get mortgage rates down. I think manufacturing is more of a wait and see. Obviously, there's a lot of uncertainty now with tariffs. To the extent that we get a trade policy clarified, I think there could certainly be some pent-up demand. But for now, it's more of a wait and see. And Kevin was asking about margins. He is asking here on a follow-up question on margins. He says, and I know tariffs will have a significant impact on your business. That I'm wondering if that's also a misread of the transcript or a mistranscribe there, because I don't know that we know that. I don't know if anybody knows that. And I think what we know is the opposite of that. But just wondering, as you think of your capital plan for this year, maybe even into the following year, are you being able to tune in the cadence of how some of that comes through to maybe avoid the risk of tariffs? Or I guess the planned outlay as we get through the next 3 quarters here, I guess relatively intact from what you would have thought. And I'm confused by that question, I gotta be honest. Mr. Vander Ark says about tariffs and I think margins, what he's saying. In 2025, it will have a minimal impact, right? It won't be zero, but we're going to have plans to mitigate that in other initiatives. And I think 26 is to be determined. We're working really, really hard, including things like asking our suppliers to spell out or specify any tariff-related surcharges on that front, because this will be an environment where it would be easy to try and pass through price increases that end up sticking if we have a different trade policy come 30 days uh, or 60 days or 3 months. So we're working really hard on that front. I think it's too early to tell. There are some minor things we're doing about moving things around the supply chain to make them, but I don't want to read too much into what I'm reading there because I think the transcript is a little messy, but we certainly can confirm by listening to the earnings call retroactively. I'm not going to do that here on the video because I think I've seen enough to form an opinion. I'll tell you what I'm seeing in the numbers there. It doesn't change my views about the company. It doesn't change the outlook of the company in the long term. However, I think we do need to pay attention to the fact that we are seeing somewhat of a very muted deceleration over the last 2 quarters. I don't think that we should read into that too much. Um, what he's saying there about construction. I made that video about Carlisle, and previously I had said that it was a strong investment idea. I had pulled that all the way down to hold, wait, and see, because what I'm seeing is that I'm seeing tough times ahead um, for construction here, and I think the commentary in our earnings here by Mr. Vander Ark and some of the numbers we're seeing in terms of volumes or commentary on volumes, I think we're seeing more evidence of that. So whereas I say that Carlisle is more of a wait and see, I also think that Republic Services is a wait and see. Looking at these numbers, I'm certainly not getting more bullish about the company, but I'm not really having my enthusiasm dampened much either. I think for my portfolio, I have a fairly overweight position to this ticker. It's roughly 4.5% of the portfolio, and um, I'm very comfortable with that position for the position size that I have relative to some of the other opportunities that I see in the market today. I am holding, even though I have recently purchased, a small amount added to my position, very small increments here and there. But seeing the earnings report, definitely doesn't compel me to go out and buy more shares of this today. And I think that that's an appropriate reaction to the earnings call. There's nothing about the quarterly performance here that makes me say that the stock isn't going to continue to perform well into the future. However, I think um, what we're seeing is the story played out in the momentum and the rate of change, the derivative of the numbers that we should continue to monitor over the next few quarters. So for me, that effectively means that for my personal purposes, that the company is now a hold. I'm holding and seeing what is going on. However, I think for investors that have a lot of cyclical exposure, a lot of semiconductor, a lot of discretionary things that I'm not really heavily invested in or not invested in at all, that the company is still serves as more of a diversification tool, and I still believe that it will fit that role well. Again, what we see here is the company has strongly outperformed year to date. You do see here that over the last 4 days, the company has been relatively flat, whereas the market has rebounded on optimism that the tariffs are going to you know, not be as or get rolled back somewhat. So that is a reasonable reaction by the market, I think. But we do have to acknowledge, uh, you know, that this company it does continue to trade as a safety, a defensive, a level of defense that is vital in today's market, and that's why it's underperformed the last few days in particular, because defensive stocks have not performed super well the last few days, including this. So um, that's a very long-winded way to say that for me, I already have a full, and not just a full position, but an overweight position in the name because I'm highly confident in the resiliency and long-term outlook of this business in the go forward. But um, I will not be buying it here because I want to see this story play out. I think if we do officially enter into a recession over the next few quarters and we see how the numbers play out here and management's commentary on that, that's what we're looking for then as a confirmation of our thesis as well. But so far, it has diverged from the market appropriately and held its price, whereas the broader market has sold off. So it has done its job. So I definitely, I'm not, changing my viewpoint of it being a buy. However, I myself am not buying here, at least right at this second, right on this day, right? So that's just my honest reaction to the numbers. Is that they reaffirmed their guidance. They're kind of dragging versus their guidance. They expect steady state growth through the end of the year. The likelihood that they hit that is strong. We are seeing, some softness there in the numbers, but not enough to confirm that there's, structural softness in the business, more of a macroeconomic thing. So um, hopefully, what I'm saying makes sense and is, that the nuance there is detectable and logical and makes sense to my viewers. Um, I think, you know, if we just look at the chart again, we just did this a few days ago, but if we look at the chart again, the stock just continues to be in an uptrend here, to be in an uptrend. Notably, it's kind of, reaching the top bound of this channel here and our lower level being here. One thing that we discussed was um, that softness in the stock and the economy might send it into more of a sideways consolidation here. So from that standpoint too, I definitely want to see how this plays out. So anyways, that'll conclude the video for today. Hopefully you found this interesting and useful for your own portfolio construction. As always, please do your own diligence and research. This is not financial advice. It's purely my opinion. I'm in the trenches and in the weeds with this stuff all the time, though. So I feel, um, like what I'm looking at here might be useful. So hopefully it is to you. I appreciate all my viewers. We're so close to 300 subscribers. Thank you to all my viewers for watching. I appreciate you. And I'm going to get started on writing. I have a lot of writing to do now to reflect some of my opinions about, the current state of things. So as always, be sure to check that out on Seeking Alpha. My viewers have the opportunity to get the premium membership at a discount. I'll have the link in the description for you. I will, continue to stay up to date on what's going on in the market, particularly in the micro sense with the companies that I'm covering and ones that I'll cover in the future. So again, if that interests you and if you found that this useful, please like and subscribe, and I will see you soon. All right, thank you.